All right, everybody. In today's lesson, we are going to be speaking about risk management and psychology. These sound like pretty boring topics, but I can assure you that if you want to have a successful trading style, you need to understand them. And I would even go so far as saying that these are the most important things that there are to understand when it comes to developing a successful trading style. Now, many amateurs and people that don't understand Wall Street believe that there's a so-called holy grail in trading. They believe that there's a system or a method that works every time and that this is the secret to profitable trading. They think that there are these crazy things like GAN theory and that, can pick the prices and the timing, and they believe that these successful hedge fund managers all have access to these secret systems. Well, I can assure you that that's really just not the case. I will say that there have been systems that have been exceptionally successful. A good example is the first high frequency trading funds. When they first came around and they were, there was only a few of them, these funds made money literally every day, and they did have the holy grail for a time being, but then the competition comes in and it doesn't work. And I've heard recently that some of these quant funds are now losing money. Now, a lot of people are surprised to hear this. Only the best traders on the street are right only 58% of the time. All right, it's not 85%, it's not 90%, it's 58% of the time. So just over 1 out of 2 trades they're successful on. The difference between successful and unsuccessful traders is that the successful traders hold on to their winners and they get rid of their losers. Now, this is easier said than done, but that is the difference right there. And the way to get around this and the way to implement the correct systems that do make money is to understand risk management and proper psychology. All right, so due to the way humans we've evolved in a way that makes it very difficult for us to successfully trade or manage money. And that's because when you enter a position, you get fright and your adrenaline starts pumping. Or if you have to decide, should I take a loss or should I take a profit, your adrenaline gets going. Now, this fight or flight response might have worked if you were hunting woolly mammoth, but it's not good for trading because it makes you make emotional decisions which are not logical. You have to remember that we're animals and members of the herd, and as such, we are subject to herd behavior and biases. And we'll talk about perception biases. And you have to remember that the desire to be correct causes many to close out their winning positions too early and to hold on to their losers for too long, because if you have a loser, you want to hope it turns around so you can say you were right. And if you have a slight winner, you want to take your profit so you can feel good about yourself, when in reality there might have been a case where you should have let the winner run because there could be considerable more upside in it, or downside if you're short. So we have to think about perception biases, confirmation bias, and this is the tendency to interpret things in a way that confirm a belief or a hypothesis that we hold. So in other words, if you just invested in, say, Apple Computer, and you see someone on television talking about how great Apple Computer is, you're going to think that, oh, gee, this person is really smart and they're an expert, so forth. If they're talking about how Apple is bad and you shouldn't have known it, you might tend to think, well, this person doesn't know what they're talking about. So that's something to be aware of, is confirmation bias. And it's not just as investing, it's in all areas of life. And if you're aware of these biases, it can help you not just in investing, but in other areas of your life as well. hopefully. The bandwagon bias. This is a manifestation of our tribal or herd instincts. I think really the most obvious example of this is with sports fans. If someone's in a restaurant or a bar and they're rooting for their team, and someone else comes in and they're wearing the same jersey or a jersey of the same team, then these people will automatically have this type of bond, right? They don't even know each other. One of them could be an axe murderer, but just because they're wearing the right shirt, that makes you think, well, gee, I have some kind of relationship with this person. So that's a classic example of the bandwagon bias. Gambler's fallacy. This is when we put too much emphasis on recent events, and they think that past events are not relevant. Like, for instance, when people say this time is different, that's an example of gambler's fallacy. Positive expectation bias. Casinos would not exist if it wasn't for this. This is when people ignore probabilities and they feel like they're going to have luck despite the fact that statistics and probabilities don't bear it out. Saliency bias comes from thinking too short term. Classic example of this is flipping a coin. I mean, if you flip a coin and you get 10 heads in a row, on the 11th flip, most people will say, well, it's going to be tails. But the reality is it's still a 50-50 odds. So you can see examples of herd behavior everywhere. For instance, fashion. I mean, who's to say, oh, well, that's fashionable? Well, the marketing teams and the fashion department. I mean, why do men wear ties and suits? They're in 200 years, assuming that we still have a civilization. People are going to look back on us and think that our fashions are as ridiculous as the fashions that we think were ridiculous that existed, 500 years ago in England, or togas in Greece, or so forth. So if you think that the clothes you're wearing are nice, it's because you're susceptible to herd behavior. We mentioned sports. I like to bring this example up at Grand Central Station because I worked in New York City for years and I went to school there. And when you get to Grand Central Station, you have to board the trains by walking down the platform, which goes parallel to the train. And when you get to the beginning of the platform, there's always a bunch of people trying to get into that first car, and you're complaining to the conductors that there are no seats, and people are agitated, and everyone's trying to stuff their packages and their bags and everything under their seats. But in reality, if you just walked around the crowd and went up 3 or 4 more cars, the cars are empty. So you can have a seat with no problem. So that is herd behavior. People see those people crowding into that first car, and for some reason, evolutionarily, they think that they have to do it too, and that it's the right thing to do. Marketing probably wouldn't exist if it wasn't for herd behavior. Another interesting herd behavior thing is to mention I live in Connecticut on the border of New York, and sometimes there's these Powerball drawings that get really, really big, like $500 million. And Powerball, they don't have it in New York, so all the people in New York come into Connecticut to buy their tickets. And what's amazing, if you get off the first exit on 95, which is exit 2, every place that sells Powerball tickets you can't get into. There's lines out the door. It's just unbelievable. Guess what? You go to exit 3 and you pull off, and you can go right up to the first gas station that you see because no one's there. So that's herd behavior. Everyone's thinking, oh, you need to get off at the first exit. When if you can think away from the herd and just say, all right, well, guess what? I'm going to drive to exit 3 or exit 4. You can get right in, get your Powerball tickets, and head right on out. And as a matter of fact, I wouldn't be surprised if there are people that actually do that and buy hundreds of these tickets and then go back and sell them to the people that are on exit 2, for twice what it cost them to buy. Maybe I'll do that the next time the Powerball gets really high. In terms of trading and investing, you have to understand that when you enter a position, you become a member of a group or a herd. So, for instance, if you buy Apple, now all of a sudden you are in the herd of people that buy Apple. So that will make you more susceptible to these biases. So just some things to keep in mind when it comes to risk management is don't think about how much you can lose, or I'm sorry, don't think about how much you can make on each trade. Think about how much you can lose. Have a defensive mindset. The best offense is a good defense. Be aware that you're susceptible to this psychology and these perception biases, and just an awareness of these will kind of change the way you look at life. Like when you drive around and you see these things and you consider, well, why does that person have a tattoo, or why is that person wearing that kind of clothes? Well, it's because they're a member of a herd. You have to understand position sizing very well, and we'll talk about this in a minute. Don't listen to the media or promoters that claim that they have a system that works. And don't guess. Make sure you have a valid reason for doing what you do. When you enter and exit a trade, you shouldn't be guessing. You should be able to write it down on a piece of paper. Like, this is why I'm entering this trade. It's because this occurred or that occurred, and so forth. So human instinct creates this need for mechanical or defined systems if you want to be successful. So you should have rules like I talked about to enter or exit trades. Like, for instance, I'm going to enter this trade because of this moving average crossover or a signal from a momentum indicator. It really doesn't matter what it is, as long as it's something that's definable and you're not just guessing. This is why quantitative funds have been so successful, because they don't have emotions. And traders have always tried to develop these mechanical systems since there was trading. I mean, there's evidence that rice traders did this in Japan, 500-600 years ago. The guys that invented the candlestick charts. So position sizing refers to the size of the position that is in your account. For instance, if you have a $100,000 account and you have 10 positions and they're all worth $10,000, then they're each 10% of the account. So there are various ways to size your positions. Probably the worst way to do it is just dollar amount. And people that are unsophisticated think about that. Well, I'll put $50,000 into it, or sounds like a good idea, I'll put $100,000 into it. The most popular way to do this on an institutional level is percentage of the portfolio. Like a hedge fund manager might say, all right, I like Apple stock, I want to make it 3% of my portfolio. Or I like Microsoft, I want to make it 5% of my portfolio. A better way to do this is to do it by the amount of risk. For instance, you weight your positions by the amount you can lose on each of them. If you put $10,000 into an option position that can expire worthless, you can lose $10,000. If you put $100,000 into an equity position that you're going to get stopped out of if it goes down 10%, then you're going to lose $10,000. So those two positions are equal. Now, this is how that big successful hedge funds work, but they're using a lot of leverage and so forth, and they have NASA scientists that do these calculations. But just for your individual trading, it's just something to consider. You don't want to have one position that can basically wipe you out. You really want to have your risk diversified across the portfolio. Another thing to think about is to have long and short positions at the same time to negate market risk. Like, if you're long all your positions and the market crashes, well, then you're not going to have a good day. If you're long half your portfolio and short half your portfolio, theoretically, and the market crashes, well, you'll break even. Here are my 5 rules for my trading. The first is that when I enter a position, I believe it's more important to know where to sell than to know what to buy. For instance, if you want to buy Apple, that's fine, but you should have 2 sells. You shouldn't just buy it as a guess and just wait to see what happens. You should say, all right, I'm going to buy Apple here, and if it goes down, here is my sell stop, and if it goes up, here is my target price. All right, so it is more important to know how to sell than to know what to buy, and I believe that's the most important rule in trading. And by doing that, that negates all this herd instincts and emotions that we've been talking about. So you also want to think about risk and the position sizing dynamics. You want to develop your own trades and don't pay attention to the news or what your friend at the club tells you. Have a valid reason for trading. If not, you're just guessing. And don't overthink your ideas. And if you follow your rules, you won't have to. All right, so here's a position that we've been watching, or I've been watching recently, and it's on my blog. And I actually just took a position. So I've been watching this 74 level as support here in the XLEs, the energy sector. So what I said is if this breaks, I'm going to short it. Now this level is 74. And I would say, all right, well, I'm going to short it at 73. My stop out is at 74. And my target is going to be, say, 69 because that's the last time it found support, or that's where it found support. So now I have a valid reason for entering the trade, okay, which is the break of the support level. I'm going to sell it at 73. Okay, I know where my stop out is, which is 74. I'll buy the cover there for a loss, which is a point. And if I'm successful, I'll cover at 69. So that gives me a theory. And now, of course, obviously, this is all theoretical. Never works out this simple. But you sell it at 73, you cover at 74. That's 1 point loss. You sell it at 73, you cover at 69. That's a 4-point gain. So we have a 4-to-1 risk to reward ratio here. So I've defined my rules. I have a reason for trading. I know where my two sells are. And I've thought about the risk. Are we good? Okay. All right, we're good. Sorry about that. All right, so anyway, so this is from August 16th, and as I speak, I believe it's August 19th. So I entered this trade last week. So this is a live trade we can keep an eye on here, not just something from the past. So this level broke, and I went short. So now we'll see how it goes. And one of the things, we'll talk about this more in my lesson on trends and levels, but you can see here how this thing rallied kind of quickly. So it really didn't build a vested interest, so to speak. A lot of support and resistance. So one of the things that's attractive to me about this trade is that there's probably not going to be too much support on the way down. And I think we saw that on whatever day this was. I think that was on Wednesday, right? Just goes up quick, gaps down. So anyway, so that's a trade that we're currently in. And you can watch on our website to see how, or on our blog to see what happens. Okay, here's another trade I was looking at, this TDMI. I mean, I don't even know what it is, Titan Medical. But this caught my eye because this thing is down big, okay? Broke a level that had been support for literally months. Down big. So what I said is, all right, here are my rules. If this thing breaks its downtrend, I'm going to buy it on the way up. My target's going to be 550 because this was the low here. My stop out is going to be 375 because this is where there was resistance back there. So again, I have the rules defined. Before I'm going to enter this trade, I know where my exit positions are, both the good one and the bad one. But now let's go to August 5th, and guess what? I never entered this trade because it's still in a downtrend. Now this is important. This trend line was never broken, okay? You need to have a reason for entering a trade. A lot of people probably just said, I mean, think about it. Everyone who bought it here is now underwater, and people probably just said, oh, this is the bottom. Oh, 375. This is the bottom. All right. So you got to have a reason. I didn't enter this trade, and I think I've taken it off my screen. And here's a point of how having rules could keep you from losing money. Now, this is something I'm currently watching. As I speak, it's Sunday, so I'm going to be watching this tomorrow morning. And this is where way I look for ideas, all right? So this thing, Zillow, had some kind of earnings blow up here. So now it's oversold, okay? It's trading at a level that was prior support. And what I'm doing is waiting for this trend line to break, and if this downtrend line breaks, I'll buy it on the way up. Based on the levels I see here, my sell target's going to be up here, 56, because that was the low here. So there's probably going to be some resistance at this level. And if we enter it at 49, I'm going to make my stop out at 48, right? So I'll go long the stock at 49. My stop out will be at 48, and my target will be at 56. So that's a 7-to-1 risk reward ratio. And again, I have clearly defined rules. So I guess just follow me on the blog to see if I actually get into this thing. But this is on the radar screen, and this is a good example of the type of things that I look at. And again, the reason why you want to have rules is because that's where risk management comes from, because that prevents your emotions from making you do illogical things. Here's another example, right? This caught my attention in mid-June. I like to go through the stocks that are making 52-week lows or 3-year lows or whatever. Look for things that are oversold and trading at levels that are support in the past, like Zillow we just spoke about. So that's the case here. All right. So again, you don't just try to catch the bottom. You have to have a reason. And my reason would be a break of the trend line. So this trade actually ended up being a nice trade. This is just a closer up picture of it. So it broke its downtrend line. Okay. It wasn't oversold anymore. So I entered it here. I chose this level for my stop out because this was the prior low, right? I didn't just pull a number out of a hat and say I'll get stopped out at 1120. I picked 1120 as a stop out because that's where the most recent low was. So I think that just is a logical place to have it. Because if it breaks this level, it's probably going to go farther. My target was, up here around 13 because that was important support back in December of 2016 and June of 2017. So it got overbought, got close to my target, and I sold it. So bought it when it was not oversold anymore and sold it when it became overbought. But again, I had my rules. I had my targets, my sell and my sell out target to take a loss, my profit target. I've considered how much capital I'm investing versus the rest of my portfolio. So I considered the position sizing dynamics. All right, so here's a trade that I actually lost money on. And I just want to show you why I decided to short this here at 28, because it broke this uptrend line and it failed at this resistance. Right, so I put on the trade. I figured it was going down. I shorted at 28. My target to cover was down here around 27, 26.80, because that's where this support was. And my stop out was 28.25. So unfortunately, this thing rallied. It got up to 28.25, and I closed it out. So I took a 25-cent loss on the position. So if you think about it, that's 5-to-1 risk-reward ratio almost, because my potential loss is 25 cents, and my potential gain is, a dollar, maybe $1.20 or so. All right, so just to summarize, just remember humans have not evolved in a way that makes humans have evolved in a way that, humans have not evolved. Actually, yeah, this is obviously a misprint here. I'm going to have to fix this. Humans have evolved in a way that makes money management and trading very difficult. It's because trading, triggers adrenaline, which triggers the fight or flight response, and that makes you make bad decisions. So this creates a need for mechanical systems. The holy grail of trading is risk management and proper psychology. It's not having some secret system that was given to you by the Illuminati that actually works every time. The most important rule of trading is that it is more important to know how to sell than knowing what to buy. All right, like I said, you should not enter a trade unless you know where a long trade, where your sell out is for a loss and your profit sell is. And obviously, the opposite is true for shorts. Um, if you don't have rules, then you're just guessing. And if you have rules and you actually follow them, you're going to be successful. All right, so thank you. That's it for our risk management and psychology lesson. Hopefully, this will help you have some successful trades and improve your trading. And I think that if you consider these dynamics, it certainly will.